Our next segment of programming here today, before we get back into pitches, is a panel that I have titled Being a Shrewd Opportunity Zone Investor. And all of the panelists on today have experience either OZ investing personally, or they are working with Opportunity Zone investors or consulting with Opportunity Zone investors or funds. And this is going to be kind of an informal conversation among the panelists here. There's no slide decks we're going to share. We're just going to kind of have a back and forth discussion. If you do have questions for us, please feel free to use the Q&A or type them into the chat, wherever is easiest for you. Some topics that I want to cover today, gentlemen, are how are savvy investors investing in opportunity zones? What types of assets are most popular? What type of due diligence and what types of questions should investors be asking before they invest in a qualified opportunity funds? I mean, the whole goal of today's panel is I want the investors in attendance today to be able to take away some practical investing advice from the perspective of the panelists here, all of whom have actually worked with opportunity zone investors, as I mentioned before. So just to quickly introduce our panelists today, I have Dave Kunz joining us from Hall Labs. Dave, can you say hello?
But thanks for having me, Jimmy. I'm happy to be here and provide any sort of insight I possibly can.
Excellent. Thanks, David. We've got Rocco Forino joining us from DealConnectHub. Rocco, could you say hello?
Hey, Jimmy. How are you? Thanks for having me.
Good to have you, Rocco. And we've got Jeffrey Maganis from Crowdcreate joining us today. Hello, Jeffrey. Chris Cooley from OZworks Group. Chris, say hello.
Jimmy, what's happening, man?
Good. How you doing? And then finally, last but not least, Gerry Reihsen from Coasis Coalition. Gerry, say hello, please.
Hey, everybody.
Okay, great. So we're all on. We can hear you and we can see you. So let's get the ball rolling here, gentlemen. I'll just throw this question out to all of you. How are savvy investors investing in opportunity zones? What are they looking for? And I'm talking about family offices, high net worth, ultra high net worth. What do you see them doing that you would consider to be a best practice? And I'll just kind of go in order. I'll start with Dave.
Yeah, I think, I sit in kind of a unique seat because I'm an investor myself in OZs. I'm a general partner within an opportunity zone fund. And I also advise family offices on allocations. So kind of seen the mix. And it's, I think it's both the bottoms up and a top down, analysis. And what I mean by that is, the regulations themselves have dictated kind of two different investment types, one being real estate and, obviously the other one being operating businesses. But even underneath both of those, there are single asset and multi-asset opportunities within real estate and in operating businesses. So from a savvy investor standpoint, what I've seen is people trying to diversify, those capital gains that they have, identify leaders within kind of their category. And what I mean by that is finding people that have, this is not their first rodeo. Finding management teams and, general partners that have expertise within the particular sector that their fund represents. And because you really have to look at this without the lens of an opportunity zone. The incentives were created to, I think help accelerate the potential investment, but you still have to say, is it a good investment? Because without the fundamental investment being solid and strong, then the incentives are not going to help you at all. So, I would do the work on, people first is the biggest thing for me. Investment type second, third, obviously where it fits in with my diversification of my overall portfolio. And, then lastly, you always have to trust your gut a little bit too.
Yep. Good point. Thanks for the insight there, Dave. Rocco, how about you? What are you seeing out there? How would you advise people be savvy investors in opportunity zones?
So to play a little bit off of what David said, one, they have to be an expert in their field. They have to be seen as, if it's a real estate development, they should know the area very well. Can't be in Connecticut trying to do a deal down in Miami. Two, should be in a really decent opportunity zone that has upward momentum, meaning that the community is behind it. They've done what they can to propel the opportunity zone so that any deal that materializes out of there has a very high probability of being successful. And investors also like access to off-market deals, so they don't want to see a deal that's like shopped around too much, or they might find that it's, no one has put any money into it, then they think that it's not that good of a deal. But definitely you have to be an expert in your field and be working in a community that has some upward momentum.
Awesome. Thanks, Rocco. By the way, I meant to point this out earlier. Rocco is the author of Opportunity Zone Millionaire. Maybe he'll instruct us on how we can get a copy of that book. Sure. Great looking book that he wrote not too long ago on opportunity zones and his perspective on it. If you want to drop a link to how we can buy that book and get a hold of that, Rocco, that'd be appreciated.
Sure, I will. Appreciate it. Thanks for mentioning it.
Absolutely. Yeah. You're too modest, so I wanted to make sure I got that plug in for you. Jeffrey, let's move to you, Crowdcreate. And Jeffrey, you personally have invested in some opportunity zone deals in the past, I believe. What do you look for as an investor?
Yeah, so this is from the lens of a passive investor where I'm not looking to do it as my full-time job. So I invested in a number of opportunity zone deals. I personally reviewed about 100 funds. I called and spoke with the sponsors of about 20, and then I ended up investing in a handful. So that's kind of my pipeline. As a passive investor, I actually only co-invest with either friends I've done, deals with before, or through these investor groups that I'm part of, where we share due diligence. And specifically, like the 4 areas of due diligence when we're considering a sponsor. First, we do a background check, asking for references for other people that have done deals with them. Second, we do an industry expert check. So say, for example, if we're investing in a mobile home park in South Carolina, we would call local brokers in the area to get expert insights on that property. Third, we have somebody on our team that basically is really good at finance. And so they're going to take their financial model, look through it with a fine-tooth comb. And then fourth, we do a legal review on their PPM and all of their docs to make sure the operating agreement is sound. And so, over the years, I've been more comfortable now just co-investing with other people I've done deals with. And when things go bad, we can all use collective brain power to, figure things out.
You're taking advantage of the wisdom of the crowd there. I think that makes perfect sense.
That's a good play, Jimmy. Yes.
Yeah, those investing groups can be crucial to underwrite some of those deals. Chris, let me turn to you now. So what are you working on in opportunity zone space? And maybe you can tell us a little bit more about OZworks Group and what you're seeing and what you think might be beneficial for opportunity zone investors as they make their investment decisions here.
Yeah, thanks, Jimmy. I mean, everything I know about opportunity zones, I learned from you and Ashley Tyson. So, people should just listen to you, probably. That's partially true. I have a slightly different approach than everybody else here, but that's because I have worked with people who are investing in opportunity zones and developers in opportunity zones to actually facilitate the growth and launch of new business development within that. So creating incubator spaces and co-working spaces, most specifically, so that the growth of the businesses within those properties can be exponential. And so what I've seen is a lot of creativity. I've had clients that have invested in bike shops and done all kinds of really neat sort of collaborative relationship type deals like Jeffrey mentioned. I think that there's a common thread here, and Jimmy, I'll touch on OZworks Group here in a second, because obviously it's something that we've been working on together. But there's things that have come up that I just jotted down, like people first is what David said. Community, making sure a community is behind your project is a big deal. What Rocco noted, and what Jeffrey just mentioned about building relationships and doing your due diligence. And so one of the things from my experience, my expertise and background is in community building, in applying that to new business development in the form of collaborative type workspaces. And so what we've been looking at is what are some of the biggest challenges for people who are creating opportunity zone projects, and the complexity of the program, and also trusting the people that you're collaborating with on these complexities. And so What OZworks Group is a project that we've been working on, this market network virtual platform where we'll actually make the connections that you need to fill the gaps for your project. And so, Jimmy, and we have a link. I think I would ask that if people are interested in having connections and having those connections facilitated and cultivated, that they join our initial sort of wait list that we have. I don't know if you want to deploy that now or.
No, I will. Yeah, thanks for bringing that up. So I just posted that link into the description there, and I'll ask you more about that in a minute here, Chris. But let's move on to Gerry Reihsen now. Gerry, I want to get your perspective. What are your thoughts on opportunity zones and the opportunity zone ecosystem, and how are savvy investors investing in opportunity zones? What are you seeing?
So, Jimmy, as you know, Coasis has a number of verticals, including advising and representing investors. In our experience, frankly, our investors are fairly high level that we bring to the table. They already have their thesis, and I recommend that they keep the thesis. So if they're a long-term investor in real estate, fine. If they're a short-term investor in development projects in real estate, that's fine. If they want to do venture investing, that's fine. Really the analysis is the same. Jeffrey touched on, an approach to that, which was a good approach and encompassed most of it. So most of our working with investors is actually finding opportunity zone funds, and we, having had a large $12 billion AUM fund company, I know most everybody in the space, finding funds that either are already adapted to or will adapt to our investor goals. So if you have a real estate development opportunity zone fund, what we want to find for our investor is a fund that permits opportunity zone investment over the long term or as the development phase. Because not every investor in opportunity zone funds are opportunity zone investors. They might want to just take advantage of the development side and then be taken out with new opportunity zone investors who want to be the long-term investors. When it comes to venture capital, do they want to invest directly in venture stage companies or through a opportunity zone venture fund? So we tend to create environments where all of the optionality is in favor of the investor. So they'll have their own little captive QOF, and they can place their money where they want, different QOZBs or in different funds. So it's not, to me, it's not so much what's a savvy investor looking for in opportunity zone funds, is are you a savvy investor? Do you have an investment thesis? And can you identify, and regardless, I mean, so they're going to invest in that thesis regardless. So can you identify an opportunity zone environment that meets that thesis, either through your own devices or through participating in a fund?
Yeah, that's a great point there, Gerry. Great perspective that you bring too. A lot of different viewpoints here, which is fantastic, I think. Next question I want to pose to everybody is, I guess it's a two-part question. What types of assets are most popular among opportunity zone investors in your experience? And the second part of the question is, what types of assets do you think are most worth pursuing? And I'll chime in here really quickly. I kind of feel like, at least at the outset of the opportunity zone program, that real estate, and particularly multifamily real estate, were the top asset classes, the most popular, the most reliable, the ones that everyone was most familiar with. But I kind of view this as, if this actually is a capital gains tax incentive, I think the best use case for opportunity zones is probably going to be in operating businesses. Getting that 100x or 1000x exit 10 years after you start holding the investment, and getting to eliminate capital gains on the back end from huge returns like that. You're not going to get those types of returns from real estate. I think that operating business is where people are going to start heading in here, especially as we got final regs about a year ago now, and everything's a little bit more clear. There's really no excuse to not do operating business anymore. But wanted to kind of open it up to the group here. What are your thoughts on the types of assets that are most popular and the most worth pursuing, in your opinion? David, I'll circle back to you to kick us off with this one. And you're on mute, if you can unmute.
I'm obviously a little biased there, Jimmy, as I'm sure you would you'd probably agree.
Yeah, and tell us a little bit about Hall Labs too.
Yeah, so Hall Labs is an opportunity zone fund. It's actually it's a growth venture fund that we were building anyway. So I think that goes back to looking at the team and looking at the experience that the operator has, and in the fact that this was going to be, we call it the Anyway Fund, but we actually, I'm embarrassed to say, the town of Provo called us to tell us that our entire campus was in an opportunity zone. So there's a little bit of luck to this also, but the reality in what we do is we've been incubating and supporting and growing and building businesses for the last 70 years. And, with almost an 8x return on invested capital over that time frame, we have the expertise and experience and the team in place with over 200 plus engineers in every vertical helping build these businesses, heavy on the patent side, where the principals of the fund were really looking to build a modern day Edison Labs, and that's what they've done. So it's about a process, and I'm a process oriented person anyway. So just ensure the fact that the people, whether it's real estate or operating businesses that you're investing with, that they have a scalable, repeatable process for what they do. And that's what's made us successful. And I don't disagree with you, Jimmy. I think people were gravitated towards real estate early on because the regs kind of pointed them in that direction. And I think real estate's a great asset. And in fact, many of my clients have made their fortune on real estate. But within a 10-year time frame, I think that return looks a little bit different than the return on a growth venture opportunity, like you said. But that doesn't mean you shouldn't have both. And I think the real estate asset is a tangible, hard asset that's probably a little bit safer, and thus that return is a little bit different. But with operating businesses, the potential to have, a 4x, a 6x, a 10x over that 10-year period of time, multiple exits, redeployment of capital. You want to think about that redeployment of capital too when you're evaluating a fund, because if they don't have other assets to redeploy into, then it's going to be back up on you in order to find another qualifying asset to put that capital in. So it's not about just the investment today, but it's about how they're going to handle exits over that 10-year period of time. And we're fortunate enough that we have probably about 25 different operating businesses right now on campus needing growth capital. And we picked the first 5 based upon criteria, and that's what's making up Fund 1. So we're knock on wood, close to some good news here over the next 3 to 6 months. But we're happy to talk to anyone further about operating businesses, because that seems to be an area where people have some questions.
Thanks, David. And by the way, I'm going to turn it over to Rocco here to give his answer, but just wanted to quickly chime in and note that I just posted links to everyone's website, all of our panelists' website, in the chat pane there. So if you want to learn more about what they're working on or get in touch, please follow those links. Rocco, let me turn to you now. Same question.
Jimmy, real quick, I also wanted to say, I think a number of us are going to be on the happy hour afterwards. So, which would probably be a great opportunity to meet some people too. So yeah. So please do join the happy hour that starts at 5 p.m. Eastern time. I'll post the link to that as well here in a minute. Rocco, turning to you now, same question that I just asked Dave. What types of assets are you seeing being the most popular, the most worth pursuing? And maybe you can tell us a little bit more about Rocco, Forino Capital, and DealConnectHub, and the types of clients that you're working with.
Yeah, so through DealConnectHub, we see a lot of startups, and we allow certain startups in our network of family offices that are highly vetted and have a very impactful business model. So a lot of the deals that we have on there are startup businesses that have a very important social impact and environmental impact components into their opportunity zone businesses. So the deals that we have and that we're about to invest in, one is a fuel cell deal that will basically take any home, community, or small business off grid. You heard me asking a question earlier if a property had natural gas. This particular fuel cell runs exclusively off of natural gas continuously, and it can be hybrided off with wind and solar. So that's one amazing deal we're looking at. You could power an entire multifamily hotel. You could take it off grid, and you could charge the tenants as an additional source of income. So now you're the power supply company, which also makes those deals, one, green, because the byproduct of the fuel cell is water, and also it's an additional income that'll probably boost the internal rate of return. Another deal we're looking at is a pain management clinic that uses laser technology. The doctor created a laser and a probe that will basically eliminate pain in any part of the body, and has been practicing it for over 8 years. And people that he's treated have used absolutely no drugs or no pain medication. So the deals that we are looking at have at least tend to have an impact on at least 1 million people. That's the kind of deals that we kind of boil it down to, and they must have a positive social impact. And the reason why I like investing in operating businesses or startups is because these are the engines of the economy. These are the ecosystems where Chris Cooley is putting together. These are ecosystem builders. This is where it starts, right? When you have startups and founders making money with their initial employees, they make a lot of money from the get-go because they have equity stakes. When you build these types of communities, they could then go and afford affordable housing and buy real estate for their businesses or homes. So if we start with that thesis, that'll support also the real estate side of it. So I think the entire spirit of the Opportunity Zone law was to, one, close the wealth gap in this country, and then provide the ability for American investors to diversify and get this capital into communities that have never had access to capital before. And to end that, I would like to say that, the biggest threat to America right now is not China. It's our inability to connect with these communities by providing them the capital that they need. And that's basically my thesis on why we should invest in operating businesses and startups, because these are the engines of the communities. And one quick point is that a lot of economic development companies that are private or run through quasi-public private entities should incorporate this ecosystem building into their thesis, because they've been existing for like 30 years now, and after that we still have 8,764 opportunity zones. So opportunity zones shouldn't rely exclusively on real estate. It should include a very solid foundation of startups and operating businesses.
Yeah, well said, Rocco. And I think you're preaching to the choir here in many ways,
Yeah.
which is great, but it's great to hear your perspective as well. Jeffrey, same question to you. What types of assets do you feel are most popular or the most worth pursuing with opportunity zones? And maybe tell us a little bit about Crowdcreate and the types of clients that you're working with.
Yeah, so the most popular asset class, arguably the most funded would be multifamily, all right, and multifamily ground up development. So in regards to being a shrewd investor, the number one I think I look at obviously is the IRR. I'm mostly targeting secondary and tertiary cities that have seen this exodus from California, New York, going into other markets. And then I look at fees for the sponsor. I want to know how much they're charging, how does the splits look? I always want to protect downside risks. I'm looking at the prefs for each of these sponsors, breaking that down. And then when I'm also looking at cities that I'm not familiar with, I also want to look at market absorption rate of these new buildings that are being built up in these different cities. Looking at how much are they building on a cost per square foot basis. Ideally, their background has been as a general contractor, where they know if there's possibly any cost overruns. I want to make sure that these opportunity zone developments isn't something new that they're jumping into. It's more like secondary part of their business where they're a developer by trade. And then I look at job growth in the area. And I kind of run this by my group. And in terms of what we do here at Crowdcreate, we actually run masterminds where we do due diligence and help investors become better investors. And as a business, we ultimately connect Opportunity Zone funds with these investors and play, a matchmaker, so to say, and helping investors find good opportunities and helping other businesses get more exposure to what they're doing. So yeah.
Awesome. Well, thanks, Jeff. And great to have you on again. Chris, turn it to you now. How about what's your answer to the question? The best types of assets, the most popular assets, the ones that are most worth pursuing. Any thoughts there?
Yeah, I mean, it's interesting, right, Jimmy? We did a presentation a couple of weeks ago with this Bluefields, West Virginia, right? And what we talked a lot about was investing on an island, like a single property versus an ecosystem. And so, Rocco, as you're talking, I'm like, all the things you're saying are pinging in my ear. That incubation and actual facilitation of business growth is this huge sort of missing piece. And I'll say, you can invest in a company, but how's the support happen with that company? And you can do that all within your potential Opportunity Zone property, right? So I don't have like as much of a range as far as experiences with investing and what are the most popular pieces of investing, but I can tell you that I worked on a lot of successful projects. And one other side note is we did a huge market analysis for the city of East Point, Georgia, which is just outside of Atlanta. And this is mostly an Opportunity Zone. And the biggest need for the businesses within that ecosystem was access to capital. And this was after months of study. And so Rocco, spot on, man. We're definitely paralleled there. So that's not necessarily a direct answer to the question, Jimmy, but I do have a couple of examples I wanted to share.
Yeah, and I forgot to ask, could you tell us a little bit more about OZworks, what you're working on there, what you're getting ready to launch? And I posted the link in there. But
yeah, I would definitely encourage anybody here who's listening to visit the link and enter some information. It's kind of like what Jeffrey was talking about, a matchmaking sort of platform here, where we're going to have a bunch of different peer support options, making connections, building relationships. It's going to be a cultivated ecosystem virtually, where we are going to have investors and developers and municipalities all within the same environment with efficiency in mind, right? Connectivity in mind, so that you don't necessarily have to go out and look for all the people to make something like this work, but that they're here and we can make introductions for you. So I know there's a couple other platforms that some of the folks that are here on this panel have put into gear as well. And we're looking at collaborating and supporting that insight and process. So I'll put the link in here again. And I would, like I said, I would encourage anybody to hit this up. We're going to have an initial sort of kickoff open house coming up soon. So get in that list and we'll see you there.
All right. Thanks, Chris. Gerry, turn to you. What assets do you like, or what assets do your investors like?
Yeah, to your actual original question, I was, fortunate to be one of the first professionals that Jimmy interviewed in his Opportunity DB podcast. And from the very first, what I loved about the Opportunity Zone incentive is that it's a market-based approach that doesn't just deal with hard assets. Hard assets are nice, affordable housing is nice, offices and industrial and all this stuff is very nice. But what the Opportunity Zone statute does is it allows persons within those zones to have a way to generate wealth, which is really what changes these things, not just putting assets in there, right? So I was really thrilled about that, and it also counters the negative aspects of gentrification. And the problem with gentrification is you increase asset values to the point where the people inside there don't have the wealth and revenue dynamics that can allow them to keep with it. Well, if you can build businesses in that space and generate wealth, it handles both sides of that equation. So I was really thrilled about that from the very first, as well before rules were maybe even out. I can't remember. Maybe the first round had come out, Jimmy. I don't remember.
Yeah, it was a while back when we talked.
But if you go way back to his podcast, you can see my.
I just posted a link to it in the in the chat here.
But what has amazed me is how little the venture capital community is paying attention to this. And the result is that there's somewhat a problematic. So I represented a client who looked at David's Hall Venture group, and we were supremely impressed with them. Sometimes they say somebody's all sizzle and no substance, and in a certain way, unfortunately for Hall, they're the opposite. They're all substance and not a whole lot of sizzle. If they could sizzle a little more, I think they might get ahead a little faster, but they're an amazing group. But there's not really too many others out there. There's some trying to do it, but I don't understand why every venture capital group doesn't have a sidecar opportunity zone fund, but they don't. I don't get it. Now, as far as what is advantage in this space, it's really, again, it's a matter of what your investment thesis is. If you are someone who wants to have some capital preservation aspects to your investment thesis, you tend to look at real estate, and you have a moderated risk environment, right? It's not an all or nothing environment unless you way over lever it. It's not an all or nothing environment. Whereas venture investing is pretty much probabilistic investing, right? Where you're all or nothing on each of your choices within the venture capital space. So from a big picture thesis, the opportunity zone benefits are much more advantageous to venture investing because they make those probabilistic winners, and of course you have to make enough of them to get the probabilistic effect, more valuable. On the other hand, the very interesting thing that ended up happening and being clarified through the rules is that the more risk moderated investor in real estate, of which there are relative degrees of risk, as I discussed before, development investors versus long-term buy and hold and capital cash flow investors, the ability to get tax-free cash flow along the way because of the effect of the basis write-up that avoids recapture over depreciation is something you really don't have in venture investing because you don't tend to have tons of depreciation or tons of distributions along the way. So it's hard to say which is more advantaged or better, but I've always thought that the venture investing is hugely advantaged, and I don't get it why I know Hall does have sizzle, David, some sizzle. Anyway, he posted something in the comments. Anyway, give me substance over sizzle.
My hat's off to Jeff. He made the sizzle.
Anyway, I don't get why the investors in the VC space haven't paid attention. Maybe because they have the advantage of Section 1202, but that only gives them $10 million of upside. Well, it could be more, but not a lot more in respect of their investments for a 5-year hold. 1202 is something that could be discussed elsewhere, but they can blend that 1202 concept with the opportunity zone concepts. I just don't get why they're not paying attention. But I'll tell you what, once they do, it's going to explode.
Hey, Gerry, I completely agree. And, hats off to Dave at Hall, because by far they're leading the pack and doing the best on the venture side. As an investor, is it a strategy, would you say, if you have Tesla stock and it appreciated, to sell it today, book the capital gains, throw that into OZ, and then immediately buy your shares back?
So we have people doing that all the time. So we do everything from multi-$100 million fund advice and capital raising and deal flow assistance to single asset individual investors who want to do the Airbnb investment, right? Broken Bow, Oklahoma is a huge area for this right now. It's a resort area in the foothills of the Ozarks. And a lot of those people come and have no capital gains until I ask them whether they have stock. And they'll say, well, I do have stock investments, but I like my stock investments. And I tell them, I don't care. Sell the stock today, create a gain, and buy it the same day. We have day traders who have a column of gain and a column of loss. We say, ignore the column of loss. All that column of gain you can use to create a tax-free investment on the upside. So we do a lot of helping people find capital gains they don't realize they have. Sometimes insurance proceeds or captive insurance arrangements, of which we're working on some things for the opportunity zone space, can produce capital gains too. There's all. You're exactly right, Jeffrey. It's a really good point. The point is this: get some capital gains and get your tax-free investment.
Yeah, because I bet people don't even realize they have capital gains if it is sitting in, say, a 401k and the baby boom.
No, they shouldn't do it from a 401k though. The 401k is already a tax advantage vehicle. It should only be from personal holdings in a portfolio. I mean, the 401k, you don't want to mess with a very nicely tax advantage retirement arrangement.
If you're past 55 and you're required to do the RMD, basically, so the older generation.
Not so sure that comes out as capital gains, but okay.
Oh,
Gerry, maybe you're the perfect person to touch on the segregation of capital gains and losses, because you touched on it a little bit there. But I think to just make sure people totally understand, that was one of the last changes they made.
Right. The point is most people net their capital gains and capital losses at the end of the year, and your accountant will do that if he's not advised to do otherwise. But, and of course, you can always amend tax returns, but you don't have to net. You can just take the gains for it. So if you have $100,000 of gains and $50,000 of losses through your day trading or whatever, and this year you can do it all the way back to year one. We're doing that for somebody right now. You don't have $50,000 to invest in net. You have $100,000 to invest, but then you'd use those losses as a deduction this year, and there's some limits on using the losses, but you bleed them out. But you still getting the advantage of a tax-free investment is huge. So you want to think before you net and not just take the gains as opportunities on investment.
And that last set of regulations allowed people to go back to 19, correct?
Well, it depends. If you have your investment through a pass-through entity, or can putatively argue you did. So we have somebody who had a pass-through entity that he meant to put his capital assets in, but he didn't in 2019. But there's a doctrine of substantial completion on the tax code. So we amended everything to say he did, because he intended to. He had the entity there. Basically, all of his capital gains from 1/1/19 through the end of this year, we're putting into if you didn't have an entity that it was held through, the capital assets that were sold or could putatively be said were held through, well, then you have since October 4 or 6, it depends on how you count the numbers, of last year to get it done by December 31st. And by the way, it's really important to do it for my investors who are high net worth and family office. I'm setting up QOF so they're ready at the end of this year, before the end of this year, so they can invest in anything. It's important to do it from the end of the year for one main reason. You can have a 55-month safe harbor period for your capital assets instead of a 31-month if you do it at the end before the end of this year.
You guys are a wealth of knowledge. Gerry, thanks for chiming in. We are supposed to be wrapping up right around now, but I think our next panelist is running a little bit late, so I don't see him in here yet. So let's keep going for a few more minutes, and we'll just push back the agenda by a few minutes if we need to. One question that's on a lot of investors' minds, and we kind of hinted at this in a couple other panels earlier today, but for those of you who are just joining us, I want to get really quickly, each of you, your thoughts on the Biden administration coming in and what you think he'll do to the program. I've heard people get really skittish about opportunity zones, worried that he's going to completely trash the OZ program. I'm here to tell you that is highly unlikely to happen. I think it has broad bipartisan support, but I'm going to go backwards now. Gerry, I'm going to turn back to you, and then we'll kind of run backward through. Gerry, what are your thoughts?
So I think that it's actually probably more likely that the opportunity zone benefit, the statute will be extended with Biden in place. I'm hopeful that they'll realize that it was really originally a Democrat-led effort that just didn't quite make it into legislation until the Trump tax reform came, and they were able to stick it into the Senate version. It wasn't in the House version. It stayed in reconciliation. It was Tim Scott and Cory Booker who got behind it and stuck it in there. I'm hopeful. The one thing, I actually think a couple of things. One, I think it's not unlikely we'll have a recession between now and 3 years from now. And I think the opportunity zone statute will be seen as actually a tool to use to combat the recession. So I think that will have a probability of having it be extended. There is a bill being considered to extend it. My biggest worry with the Biden administration is not whether the opportunity zone statute will stay in place, but whether they'll start to layer on things that will turn capitalists off and make it more trouble than it's worth, as they've done with almost every other program that is intended to benefit less advantaged, low income, low investment communities.
Okay. Hey, by the way, we do have our next panelist here, so I do want to wrap things up. So I'm going to change of gears real quick. Just give me a quick 30 seconds, final thoughts on opportunity zones, and you can address the question I just posed to Gerry if you want to. Otherwise, just quick closing thoughts, 30 seconds, and we can move on here. Chris, to you, please.
Closing thought. Thanks for having me, man. I've been tuning in all day, and it's fantastic. That's what I'm going to close with.
Awesome. Thanks, Chris. Jeffrey.
If you're an investor or deal sponsor, like Jimmy said, we believe in the wisdom of the crowds and for everybody to get together, share insights. And so, feel free to email and join our next mastermind. I'm happy to connect with everybody on here. So
awesome. Thanks, Jeffrey. Rocco.
Hey, Jimmy, thank you for having me. Great information. And I definitely think this will get extended out. I think it'll be one of the only economic development tools that'll help this country move forward. With interest rates being so low, they can't lower them anymore. Quantitative easing is probably going to run out of gas. This might be the only economic development tool that might stimulate this country from competing with the rest of the world. And I'd like to say that this is probably the best thing that's happened since Trump came into office.
Yep, I don't disagree. Dave, I'll leave you with the final word here.
Yeah, no problem. Jimmy, thanks for having me. Other panelists, great to meet the ones that I hadn't had an opportunity to talk to. But yeah, I think more importantly, we're all here for a resource for anyone on this call, and happy to talk to anyone. My thoughts are, a lot of the foundation for the Opportunity Zone legislature was based off of the new market tax credits that had been around for almost 30 years. And that was really a Democratic, legislature program. So my guess is it will continue. And I'm hoping for additional support, because I think we have seen a lot of positive things come out of this so far, and hope to continue to do that. But thrilled at what's happened. Glad people are over the shiny new toy of a new asset class and starting to participate. That's the most exciting part.
Awesome. All right. Well, thank you all for participating today. Dave, Rocco, Jeffrey, Chris, Gerry, thanks again.